In the first quarter of 2002, WorldCom reported a profit of about $130 million. It was one of the largest telecommunications companies in the world, the second largest long-distance carrier in the United States, built from a small Mississippi reseller into a global empire. But the profit was not real. Without a set of accounting entries buried deep in its books, that $130 million profit would have been a loss of roughly $395 million. The gap between those two numbers, between a healthy profit and a deep loss, is the entire story. Between 1999 and 2002, WorldCom overstated its assets by more than $11 billion in what was, at the time, the largest accounting fraud in the history of the United States. The method was not exotic. It required no offshore accounts, no shell companies, no complex derivatives. It came down to a single deceptively simple trick: taking ordinary, everyday expenses and pretending they were long-term investments. WorldCom filed for bankruptcy in July 2002, then the largest bankruptcy filing in American history. Investors lost more than $180 billion, and in 2005, its founder and chief executive was sentenced to 25 years in prison. This is the story of how a giant hid $11 billion in plain sight, and how a small internal audit team, working at night, brought it down. To understand the fraud, you first have to understand how fast WorldCom had grown, and how much its story depended on its stock price. The company began in 1983 as Long Distance Discount Services, a modest long-distance reseller in Mississippi. Its longtime leader, Bernard Ebbers, a former basketball coach who became known in the industry as the telecom cowboy, led it from 1985 onward. Under Ebbers, WorldCom grew not mainly by building things, but by buying them. It made a long series of acquisitions of other telecommunications companies, culminating in its 1997 merger with MCI, which transformed it into one of the largest long-distance companies in the country. That growth by acquisition strategy had a hidden dependency. Each acquisition was fueled in large part by WorldCom's rising stock. A high share price was the currency the company used to keep buying. So the pressure to keep the stock high, quarter after quarter, was not just about ego or bonuses. It was woven into the company's entire business model. Then, around the turn of the millennium, the environment turned against them. The telecommunications boom cooled. The company had invested heavily in expanding its network, anticipating that customer demand would keep climbing, and that demand did not materialize as expected. Revenue growth slowed just as Wall Street's expectations remained high. That collision, slowing real performance against unyielding market expectations, is the pressure point where the fraud began. The company had a choice: report the disappointing truth and watch the stock fall, or make the numbers appear better than they were. According to the case that federal prosecutors later proved, WorldCom's leadership chose the second path and made it a mantra. In the words that its chief financial officer later testified he heard from his boss, "We have to hit our numbers." The mechanics of the WorldCom fraud were, at their core, almost embarrassingly simple, which is part of what makes the case so instructive. The key was a distinction that sits at the heart of accounting: the difference between an expense and a capital investment. When a company pays for something it uses up in the ordinary course of business, like the fees it pays to lease telephone lines to carry calls, that is an operating expense. It gets subtracted from revenue in the current period, and it lowers reported profit right away. But when a company buys a long-lived asset, something that will generate value for years, like building a network, that is a capital expenditure. Its cost is spread out over many years rather than hitting the books all at once. In the current period, it barely dents profit. The two are treated completely differently, and for good reason. One reflects the cost of running the business today, the other reflects an investment in the future. WorldCom's fraud was to take one and disguise it as the other. The company was paying enormous sums in what are called line costs, the fees it paid other carriers to use their networks. These were ordinary operating expenses, and they were supposed to reduce profit. Instead, WorldCom's accounting began shifting billions of dollars of these line cost expenses off the income statement and onto the balance sheet, recording them as if they were capital investments. The effect was transformative and false. By moving current expenses into the category of long-term investment, WorldCom made its costs appear smaller and its profits appear larger. The company looked like it was still growing and still profitable, exactly when Wall Street needed to see it, even as the real business was struggling. The chief financial officer, Scott Sullivan, was later described by the sentencing judge as the architect of the scheme. The fraud unfolded over roughly 1999 to 2002, and it grew as the pressure grew. When the internal investigators eventually reconstructed it, they found a specific set of entries, dozens of transfers moving line cost expenses into asset accounts. The internal audit team ultimately identified 49 of these prepaid capacity entries, totaling about $3.8 billion in transfers across 2001 and the first quarter of 2002 alone. That was the piece of the fraud that first came into focus. The full overstatement, once everything was uncovered, would climb past $11 billion. There is a justification that was later offered for these entries, and it is worth stating fairly. When questioned, Sullivan argued that the costs related to network lines with low usage, and that because the lease costs stayed fixed even as revenue declined, capitalizing them could be justified under an accounting concept called the matching principle. But when the company's external auditor was asked directly whether standard accounting rules supported the entries, the answer was that they did not. There was no justification under generally accepted accounting principles. There is a striking detail in who that external auditor was. WorldCom's account had been handled by Arthur Andersen, the same auditing firm that had signed off on Enron. After Andersen was indicted in the Enron scandal and effectively collapsed, its practice handling WorldCom was absorbed by another major firm, KPMG, which inherited the account. So the two largest accounting frauds of the era were, for a time, connected by the same failed auditor. A vivid illustration of how a single breakdown in independent verification can sit beneath more than one disaster. The fraud was not uncovered by regulators or by Wall Street analysts or by the external auditors. It was uncovered from the inside, by people who worked at WorldCom and decided to keep asking questions. The central figure was Cynthia Cooper, the vice president of internal audit. Her team began noticing entries that did not make sense, large transfers that seemed to move costs in ways that had no clear business justification. What happened next is one of the most quietly dramatic episodes in the history of corporate fraud. As Cooper's team dug deeper, they encountered resistance from within the company. A senior figure sent messages suggesting the audit was wasteful and was tying up employees who were needed elsewhere. Rather than back off, the team pressed on, and to avoid drawing attention through the increased server activity their data extraction created, they began doing much of their work at night. In June 2002, digging through the accounts, they found it, entries moving enormous sums from the income statement, where expenses belong onto the balance sheet where assets belong. When they ran the numbers, the implication was stark. Those entries were the difference between the profit WorldCom had reported and the loss it had actually incurred. When the chief financial officer was questioned about the entries, he offered his explanation about network line costs and the matching principle, and asked the internal auditor to postpone part of the review. But the team escalated their findings to the company's audit committee and its board. Once the board understood what had been found, the truth could no longer be contained inside the company. On June 25, 2002, WorldCom publicly admitted that its accountants had overstated earnings by about $3.8 billion. The next day, the Securities and Exchange Commission filed civil fraud charges, alleging a concerted effort to manipulate earnings to meet Wall Street targets and prop up the stock. Later, the company would admit to misclassifying billions more. The $3.8 billion was only the beginning. Once the fraud was public, the collapse was swift and brutal. WorldCom was already carrying about $30 billion in debt and was facing the SEC investigation. The disclosure destroyed what remained of investor confidence. The company announced plans to lay off 17 employees, and on July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection, the largest bankruptcy filing in United States history at that time, surpassing even Enron's collapse months earlier. The damage radiated outward. The fall in WorldCom's stock wiped out enormous value. Investors ultimately lost more than $180 billion. Retirement accounts and college savings funds tied to the stock were devastated. Tens of thousands of employees lost their jobs. Then came the legal reckoning, and unlike some corporate collapses, this one produced real criminal consequences. Scott Sullivan, the chief financial officer, was indicted in 2002. Initially, he denied wrongdoing, but in 2004, just before his trial, he pleaded guilty to fraud and conspiracy and agreed to cooperate with the government. He became the star witness against his former boss. On the stand, he testified that Ebers had repeatedly urged him to hit the numbers, which he understood as a command to adjust the books to meet Wall Street's expectations. He described an October 2000 meeting in which he said he showed Ebers a plan to improperly create $133 million in revenue and told him it was not right. Bernard Ebers, the founder and chief executive, maintained that he had been unaware of the fraud and that it had been engineered by Sullivan. His defense argued that the chief financial officer was the true mastermind, keeping his boss in the dark. The trial came down to a question of whom the jury believed. The jury believed the government's case. On March 15, 2005, after 8 days of deliberation, Ebers was convicted of conspiracy, securities fraud, and filing false statements with regulators. That July, U.S. District Judge Barbara Jones sentenced him to 25 years in prison. At the time, the harshest sentence yet handed down in the wave of corporate scandals of that era. The judge stated that the evidence showed Ebers had repeatedly misled investors and employees. Sullivan, despite being called the architect of the fraud, received a 5-year sentence, a reduction the judge explicitly tied to his cooperation, which prosecutors said was essential to convicting Ebers and to serious illness in his family. Other executives who pleaded guilty and cooperated received lighter sentences, ranging from about a year to probation and home confinement. A court-appointed examiner, former U.S. Attorney General Richard Thornburg, later summarized what had happened inside the company as a smorgasbord of manipulative schemes designed to cook the books, and described a breakdown in all of the checks that were supposed to ensure the integrity of the company's reporting. Bernard Ebers served about 13 years in federal prison. He was released in late 2019 due to declining health and died in February 2020 at the age of 78. The WorldCom case endures as a teaching example because its central trick was so simple and its warning signs so instructive. The first lesson is about the line between an expense and an investment. That distinction is not accounting trivia. It is one of the fundamental controls that keeps financial statements honest. An expense reduces profit now. An investment is spread over years. By systematically relabeling one as the other, WorldCom could manufacture profit out of ordinary costs. Anytime a company's reported earnings depend heavily on how aggressively it classifies its spending, that is a place to look closely. The second lesson is about the danger of hitting the numbers. The phrase that ran through this case, the pressure to meet Wall Street's expectations no matter what, is one of the most reliable warning signs in corporate fraud. When meeting a target becomes more important than reporting reality, the target stops measuring the business and starts distorting it. A culture that treats the stock price as the goal, rather than a result, is a culture that has quietly changed what success means. The third lesson is about the people who see it first. WorldCom was not exposed by its powerful external watchdogs. It was exposed by its own internal auditors, a team that faced internal resistance, that worked nights to avoid detection, and that refused to stop asking uncomfortable questions. Cynthia Cooper and her colleagues are a reminder that the most important line of defense against fraud is often not a regulator far away, but a person inside the organization with the integrity to keep pulling the thread. Fraud at this scale is rarely invisible to everyone. It survives only until someone with access decides not to look away. The fourth lesson is structural, and it connects WorldCom to its era. Coming so close on the heels of Enron, the WorldCom collapse helped convince lawmakers that the system for ensuring honest corporate reporting had broken down. Together, the two scandals produced the Sarbanes-Oxley Act of 2002, which imposed stricter requirements on financial reporting, made senior executives personally responsible for the accuracy of their company's statements, and increased the penalties for corporate fraud. The rules that govern public companies today were shaped, in large part, by exactly this failure. WorldCom did not collapse because its technology failed or because a market disappeared overnight. It collapsed because, for years, it told the world it was profitable when it was not, by hiding ordinary expenses inside the language of investment. In the end, the largest accounting fraud of its time was undone not by its complexity, but by its simplicity. Eventually, someone added up the real numbers, and the real numbers did not lie. There is one more thing worth sitting with. The trick at the center of this case was not clever in any technical sense. It did not require genius or secrecy so deep that no honest person could ever have found it. It required only that enough people under enough pressure agree not to ask the obvious question, and that the few who did ask be ignored or overruled. That is the uncomfortable truth WorldCom leaves behind. The largest frauds are rarely the most sophisticated. They are the ones where the pressure to hit a number quietly became more important than the truth, and where, for a while, almost everyone found it easier to look away than to add up what was actually there. This video is for educational and informational purposes only. All information is sourced from publicly available documents, regulatory filings, and credentialed news organizations. Bernard Ebbers was convicted and sentenced to 25 years in prison. He maintained that he was unaware of the fraud. Scott Sullivan and other executives pleaded guilty. Source links are available in the description.